And off we go.
Did the recording start? Okay. All right. Good afternoon, everyone. Thank you for being here. We're going to get started. I want to present Professor Anthony Levis, or we call him Tony.
That's right. That's the way to
go. His primary area of interest is portfolio analysis, and he also does work in financial market behavior, corporate governance, and financial education. He teaches mostly at the MBA level. He's an amazing professor and chair of the Department of Finance.
Thank you.
No problem. And without further ado, I hand it over to you. And I know that we're going to have a great presentation. Thank you for being here.
Thank you for the confidence. We'll see where it goes from here. As some background for everyone, I'm not a pure academic. I'm not a theoretician. I don't wax and wane philosophically very well. I don't think necessarily conceptually well either. I'm not a good creative writer, and I struggle through Shakespeare. So with the research that I do, and I have an active research agenda, the one word that is indispensable for the research I do, data. In fact, in many ways, it's all about the data. If I can date myself for a moment, I'm probably going back more than 20 years. There was Jerry Maguire, show me the money. For me, it's show me the data. Let me run the numbers, because without the numbers, as far as I'm concerned, you can talk all day. In fact, this will sound strong since I have some Wall Street experience, most of which is talked about on the internet. This is a strong word, but as far as I'm concerned, without the numbers, most of it is vomit. You know, just something to be spat out and just to be let go. Give people a chance, if you will, to be on the air and to show themselves and to talk for a while. But as far as I'm concerned, unless you can show me the evidence, show me the numbers, I am not interested. I'm not interested. In fact, as something of off the cuff here, this will be very narrow-minded, okay? I'll admit that. I actually run a research seminar series, and sometimes people will present things conceptually, and sometimes they have some great presentations, really articulate and convincing, you know, call it concepts. But sometimes at the end, I've been known to raise my hand and say the following: as crass and as crude as this will sound, can I make any money off this? And when someone says, not really, then a part of me just says, okay, I'll look for the next opportunity, okay? I know that's not very academic and not very scholarly, but it's honest. So I teach, as Chelsea was saying, a course in portfolio analysis. And I teach it differently than most people would teach a course like that. First of all, it meets in 9 straight nights from 6:30 to approximately 10 o'clock. And in many ways, it's all about 2 words: equations and numbers. And just to give you a picture of what we mean by portfolio analysis is not so much a case of selecting securities, but once you've selected whatever you want to invest in, whether it's stocks, bonds, real estate, whatever, how do you put the securities together? So for instance, example that just comes to mind, if you're interested in baking bread, you can have the world's best flour, the best yeast, sugar, honey, salt, whatever it is you want to put into that bread. But if you don't know the proper ingredients, you're lucky you're going to get a pancake and it won't taste very good. And that's a mistake people often make. They will select things, but they don't know how to put them together. And so that's what we do in this course. But in order to do that, we have to look at data. And that's really what I'm going to do at this time. I'll show you the data that students work with. And it's the same data that I work with when I'm, let's say, offering some financial assistance to people. Yes, I don't show these data to the people because they'll say, what are you doing to me? Instead, I'll at least show you what the background is. If I can get to this. Here we are. In this particular case, these are data that we used in the fall semester for portfolio analysis. Across the top here, where we start with dates and we come across, these are the ticker symbols for over 400 different stocks and bonds, all the way across. As you can clearly see, we can work with some numbers, okay? I asked the students to work with all of these numbers. And so I won't take us back that far all the way to the end, because that's going to be over 400 columns we'll go through. But notice, we begin in this case with data. These are all monthly rates of return. Monthly rates of return. In fact, the 2 things here that we really need to focus on And with all these data, it really boils down to really two things: return and risk. Return and risk. And I'll try to explain that in just a moment. But here's what the students do. They take these 5 years of monthly rates of return. Okay, they build the portfolio in this case as of December 31st, okay, at 11:59 p.m. And then they test to see how well the portfolio does. So we do this realistically. And I'm not afraid to share with everyone, it's out in this case to see if you can beat what they call a broad market index. We can get into all kinds of technicalities, but I have a side interest in this too, because I cannot track what's going on with 400 companies. The students often unearth or uncover companies that I can invest in and make some money off. So it becomes a two-way street. So I have a vested interest in their success in doing well with this particular project. But the point I want to make here at this time is, notice we're working with a lot of data. We're working with a lot of data. And when it comes to looking for returns and dealing with risk, we also have to think of a third word here. It's called diversification. You don't, and this is true, I've tried it and I've lost, you don't want to put too many eggs in one basket. You want to, if you will, diversify. And so as you can see, we have a way of measuring that. We have correlation coefficients below here. So we got all kinds of numbers here we can work with. So there's no shortage of data. No shortage of data, but that's what we need. Without the data, all I can do is sit up in front of a screen all day and talk. But let's work the numbers. Let's run the numbers and see what they reveal and conceal. For example, everyone, of course, has heard of this particular symbol, AAPL for Apple. Now, here's just a question I asked students. This is as though I were running the class. I said, let's take a look at the monthly rates of return on Apple. And how do you feel about these rates of return? You can see in first of all, in January of 2015, you were up 6.1%, 6.14%. Then in February, 9.64%. But now you're down minus 2.75%. Up a little bit, down, up, down. You can see it bounces around. Whoops. By December of 2015, you're down 10%. How do you feel about that? Then in January, you're down another 7.5%. A couple months later, you're down almost 14%. Can you deal with that? Yes, there are times when it's up, other times when it's down. How do you feel about that? Now, we have ways of measuring that, but as I'm just scrolling through these data, and I'm sure everybody can see what's going on, there's some times here you get 19.62% in 1 month, you're feeling great, you know, but then it's followed by 3 consecutive declines, and suddenly that 19.62%, disappears. And then you keep looking. So in December, we're up 10%. So you ended, we can see, we have September, October, November, December. You were ending the year on a smile. But along the way, as you can see over these 5 years, there were some months in which you were smiling and other months which you were frowning. Now, just for perspective, I say only for perspective, because just by looking at Apple alone, you really can't tell much. Let's check another company out. This is a little bit more of an obscure company, but still one that's really worth looking at. This is a company called Advanced Micro Devices. Advanced Micro Devices has pretty much is this time pushed Intel aside as the top chip manufacturer in terms of speed. And so by comparison, look at some of these returns. Look at this streak right here, month after month. You got to be jumping up and down. This is great. Huge returns. But you know, there's going to be some times when it's going to be falling. Still, this is doing really well. But watch what happens as we get farther down here. Oh, these are great returns. Oh, look at this. You're down 41% in 1 month. Now, the point I'm trying to make in all of this is it's not just about return, but it's about return to risk. So although I don't, if I will say, quote Shakespeare very well, I do have this one that I keep in mind. To thine own self be true. Know what you can put up with. So to explain this term of return and risk together, when I say everything in life is return to risk, we can think of it this way. In order for any of us to get anywhere out of life, we have to get out of bed every morning. And if you know anything about, let's say, physiology, the risk of a heart attack is greatest, if you will, in the first early hours of the morning when you're getting yourself up. The blood pressure rises, the tension rises, the stress rises. That's when the risk of the heart attack is the greatest. But at the same time, if you don't get out of bed, you don't get anywhere in life. So the question is, how much risk are you willing to take to get the return that you're looking for? And so, in fact, when I'm ever met with clients, I actually ask them some questions just to understand what they're willing to put up with and what they're looking for. And you'll be surprised how many people would just say, I'm just looking for some big returns. To which I sometimes respond, can we get a little bit more specific? We could offer big returns, but along the way, you may not like the ride. Once again, I guess to date myself from some of these commercials with Nissan, enjoy the ride. You know, you don't want to be getting up, let's say, at the end of every month and saying, in some cases, why am I down 12%? Why am I down 15%? In other months where you're euphoric, where you may be up 20 or 30%. You know, you want to really seem to find ways of evening out those flows just so you can rest a little bit more comfortably and make sure, of course, there's not a lot of palpitation in the heart. So anyway, with all these data, students have to build what we call an efficient, or they sometimes refer to it statistically as a mean variance efficient portfolio. So I asked them, they have to choose at least 100 of these securities, at least 100, and build an efficient mean variance portfolio. And to give you an example of what students would do, out of all these particular companies, there's a variety of equations that people use, but let's see if I can take you to another one. Here's where a student, indeed, by the way, can anyone see any of this?
Yes.
Or if I go here, there we go, try this. Hold on, one moment, I have to do this. Go back. Give me just a moment here. Okay, you can see all these data. The next set of data I wanted to show aren't showing up. Now, what do I got to do here to make that happen? Let's see here. Let me get out of here, stop sharing that one. Maybe it'll let me share this one now. If I do this, maybe this will help us. Bingo, there we go. Just so you know, there are a variety of equations you have to go through, but you don't have to have a deep background in math or statistics to do this. All you need to understand is simple mean variance analysis. But here a student built this so-called optimal portfolio from all those securities. And the interesting thing is, you have to meet certain criteria. And yes, we're going to go through some numbers here. But here is the key point I'd like to stress to everyone. Here is the portfolio. Out of those 400 plus securities, if we come on down, how many make the portfolio? Looks like we have, see, 6 to 30. We have 25 securities to make the portfolio. Notice, out of all those securities, only 25, based upon the criteria that we've set up, actually make a portfolio. So we could put that, if I may say so, in Roman Catholic terms or in biblical terms. Many are called, but few are chosen. And so in this particular case, we might be able to recognize a couple of the companies here. Sometimes these symbols, of course, are going to be obscure, but one you might recognize is right here, MCD, McDonald's, i.e., maybe you deserve a break today. If we come across, according to the portfolio, in this case should get, we get right here, almost there we are, should get about 8% of the portfolio. I happen to hold a little bit of McDonald's, not that much, but 8%. Another company that I hold, based upon what the student revealed, is right here, a company called United Healthcare. And believe it or not, this particular portfolio says we should be holding about 4.5% in United Healthcare. I'm currently holding about 3%, so I'm not quite following this as rigidly as we have here. But the point is, I can use this information to build my own portfolio. Now, this is not all. What the student then did after building the portfolio, you can see he started with all these particular companies. A lot of work, of course, running a lot of numbers. we get down here far enough, here we go. He's then seeing on a month-by-month basis how well the portfolio is doing. And he even gives a graph here of the return comparison, as well as what we would say a return to risk measure. So this way, as I told them, if you like what you see, go out and invest them. Now it's now 3:15. Would you like for me to continue, or should I stop here?
Please continue.
Are you sure?
I'm
Well,
positive.
let's pause here for a moment. Does anyone have any particular questions? I can talk about this stuff, of course, all day, but the key is there anything anyone would like to ask at this stage?
Can you just refresh everyone's memory on the formula that was used to build the portfolio?
Woo! Well, since you asked, give me one moment. Okay, let me do this. I'm going to go to Seton Hall. Here we go. We'll pull it right up as it's listed on Blackboard. This is what the students have access to. Here we go. Give me a moment here. Almost there. Here we go. One moment. Almost there. I've got it pulled up. Let me go back here. Here is what we call the sheet. Here is the formula, Chelsea, to answer the question. See this thing right here in the lower left-hand corner? Now, yes. This looks, if you will, somewhat discombobulated. Oh, that was Lisa. This may look somewhat discombobulating, but trust me, it is easier done than said. I actually break it down for students so they can see exactly what they have to do. You can build an easy template out of it. So it works pretty smoothly. And believe it or not, it may look complicated, but as I said, it's easier done than said, and you'll be surprised how easily this can be applied. Because you can get the data directly out of Yahoo Finance, you can download the data, I can show people what to do, and in effect, it's just away they go from there. My job, as much as anything, is to point students in the right direction. Because in the end, I don't want students to make the same mistakes that I've made. For instance, as I share with students, I made a lot of mistakes in this business, but the first one is the one that's most memorable to me. True story. I was in the Indiana University at the time, and a student dropped by my office, and he came by and shut the door behind him. Now, immediately, I got just a little bit nervous, so I just leaned back in my chair, and he says, "I have a hot stock for you." I said, "Tell me." He says, "It's a company called Microenergy, and I know who's going to be the next CEO." So I listened to him, and I was invoking what I refer to, ladies and gentlemen, as Disney's first law, that wishing may make it so. So I went out, ladies and gentlemen, and I bought 30,000 shares of this stock. 30,000 shares, but at 19 cents a share, okay? And believe it or not, within 3 weeks, I doubled my money. And in 6 weeks, another 50% increase. I'm feeling pretty good, okay? Light bounce in my step, this is okay. Well, make a long story short, I sold the 30,000 shares years later for $1, not $1 a share, but a single dollar to demonstrate to the IRS that I lost all my money. So the lesson I provide is good judgment comes from experience, and experience often comes from bad judgment. And as I said before, I was invoking Disney's first law that maybe with, oh, I don't know, Tinkerbell and Jiminy Cricket, whistle while I work, and suddenly, I'll become rich overnight. Well, it didn't happen that way, okay? So I found out, okay, what are you gonna do about that? So I decided maybe I'll put into practice the very principles that I teach. And lo and behold, that seems to work a lot better. So that's when I said, the only way to figure out what I'm going to be doing is run the numbers, to look at the numbers and run the numbers. And this is the kind of research I do as well. I've done a number of different studies, different papers to show people where not to put your money. For example, I finished a paper recently that's still out there that I'm hoping that I'll at least get a revise and resubmit that shows that Berkshire Hathaway is not the investment that many people tout it to be. How do I determine that? I ran the numbers. I ran the numbers from 1990 through 2019, lots and lots of numbers, almost blowing up Excel programs. But in the end, I got the answer. So back to the data once again. Excuse me. Oh my. Other questions, comments, criticisms, points of discussion, difficulties, complaints, querulous inquiries, anything you want to ask?
Anthony, I have a question.
Of course, Lisa, naturally.
Of course, you know that I always have questions, my friend.
Of course, and I recognize your voice.
OMG, I can't hide, can I?
No, you don't want to hide.
Too many high flex meetings.
Yeah, that's true.
So you sort of answered this by saying you have to have tons of data, but
Right.
To what extent are past returns correlated with future returns? Because that seems to be a bit of a crux to this.
You are 100% correct. I can use the past returns to get an idea of the expected returns, but whenever I'm running tests, like I do with these data, we will use the, if you will, in-sample data, okay, to build whatever model it is we're building, but then we will test going forward to see how well it works. Because it's easy, as you know, for any of us to know, to look back. You know, it's, I've sometimes shared this with students. In the 1990s, a goal that I had was to become a millionaire before I reached the age of 50, okay? And I did it. I took some extraordinary risks to do so. And I did it. And then when the so-called Y2K came, I got hammered. I got smashed, you know, to smithereens in some respects. And what I had to end up doing is, I said, okay, I went back and I generated a lot of numbers. And I found, in some cases, for instance, I had quite a bit of money tied into two companies with a correlation coefficient historically of 0.89. They were dancing in the Fred Astaire, Ginger Rogers tradition, cheek to cheek. And so when one went down, the other one went down. When one went up, the other one went up. And it was too much for the ticker to take when I had that kind of situation. Now, as I continued to move forward, I continued to look at those data and I see things did not change much because they were both in the same industry. So in that sense, the historical data gave me a pretty good peek at what was going to happen going forward. So I said, I need to get out of this. I can't take this. On the other hand, too, when I was looking at Berkshire Hathaway would have some really good, strong runs. And then suddenly in 1 year, you might lose 23%. That's where you have to be careful. That's why I say, when people tell me things such as, well, if you would have invested in Berkshire Hathaway in 1976, by the year 2019, you would have earned blah, blah, blah. That doesn't help me much because that's only looking in the past, as you're saying. It reminds me of, you know, that quote, if I knew then what I know now, I wouldn't be on this call. Okay, something like that. But I have learned really the hard way, and this is what I try to teach students. I've taken a lot of chances. Some of those chances didn't work out well. Others did. But in the end, as you continue to play in this area, you get to know more about yourself, what you can put up with and what you can't. You know, and, you know, again, back to Shakespeare, to thine own self be true. I know that's a long-winded answer, but continue, please.
No, that's interesting. So are you managing the university's endowment funds, for example?
Well, you know, I never reveal, you know, private client, you know, concerns. But to answer your question, the answer is no. But it's occurred to me at times when I've noticed a little bit about its return. I know I could do a little bit better without taking more risk. But yeah, I can, if I really wanted to, I could bring that up to the board of directors. But at the same time, or board of regents. But no, I can also say this much too. Having been in this business for 35 years, both in the academic world as well as in the professional world, I can say this much as well, that it's time, to hang the spurs up after a while and ride that pony out into the sunset and turn it over to the generations behind me and let them run a better race. And that's really what it's all about. We're handing off the baton so they can run a better race. And I'm showing them some of my experiences so they don't make some of the same mistakes that I've made along the way.
And I shall leave the floor to the next generation.
Yes,
Thank you.
we'll leave the floor to the next generation, indeed. Other questions, comments, criticisms, suggestions, querulous inquiries?
Tony, this is Lisa, the other Lisa.
Oh, yes, Lisa.
What would you recommend to, students who may not have their first job yet, when they get that 401k form, what should they do?
Oh, okay. Investment advice, eh? Well, this is being recorded. I have to be careful, of course.
I know.
But first and foremost, again, if you're not sure what to do, one place where I ask people to put some money, since you're going to be there for the long haul, is to put it into a simple equity index fund. One that I like is with the symbol V as in victory, F as in Frank, I as an icicle, A as an apple, and X as an X-ray, VFIAX. It's what they call, it's an index fund from the Vanguard family that tracks the Standard & Poor's 500. Now, the reason I mentioned that, and this was going to sound technical, but as I sometimes tell people, we're here on earth to do one thing, beat the market. Now, beating the market means a lot of different things in a lot of different respects. But one thing is the reason people are pursuing, an advanced education like this at the university level is, you don't want to be left behind. You don't want to be, as we would say, since I'm from Indiana, the runt of the litter. So you're not only trying to keep up, but you're actually trying to stay one step ahead of the crowd. It's similar to when you go to a restaurant, make a reservation to make sure that when you show, there's a table waiting for you rather than having to wait 45 minutes or an hour for the next table. And so this is all part of preparation in that respect. And so what I'm trying to say is a lot of people will tell you, hey, you should invest in this stock or buy gold or buy real estate. Instead, if you get confused by that, just put, let's say, in a 401k or 403b, put it into a broad-based index fund and go to bed. And in effect, forget about it.
Right.
And just keep putting the money in, whatever amount you want to. For example, at Seton Hall, if you want to put in, 4%, just put in the 4%. Do it every month and just forget about it. Don't bother with it. Don't bother looking at it. Just let it do what it's supposed to do. And let, if you will, the power of compounding work its magic. Over the last 70 years, the average rate of return on an index fund is about 9% a year on a broad-based equity index fund, a stock index fund, 9% a year. That means you'd be doubling your money about every 8 years, which isn't bad. And you'll be surprised how the power of compounding works. I've got a bunch of stories there too, and I can stop right there. If you want me to continue, I will.
I think, yeah, why not? If people need to go, that's fine. But I think it's important to understand what that concept.
Yeah, here's the power of compounding. True story. I was living in Indiana at the time, and there was a young lady at the time, who had just inherited $40,000 on the death of her grandmother. She put that $40,000 into a stock at the time in 1992, it was early 1992, called Cisco Systems. Her $40,000 over that time, by March of 1999, had climbed to over $3.5 million. That's the power of compounding. She was earning, in some cases, in some years, more than 100% a year. She was in the right place at the right time. Now, to add a touch to the story, it's easy throughout life to get into things. When do you get out? She didn't, as he would sometimes say in the investor world, she didn't take her profits. She continued to hold the stock. She held it, okay, through 2002. The stock then went from $77 a share to under $10 a share. And so guess what? Her millions went, in this case, just to mere thousands. So I remember one point when I was talking to her on the phone, because by that time I had moved to New Jersey. I said, so what are you doing? She says, well, I'm no longer planning on the swimming pool, and I decided to give up on another new car. And well, I was going to help my parents out, but I won't do that now. You can see. So what I'm trying to emphasize is it's easy to get into things. How do you get out? So when you're buying, also in some cases know at some point when you want to sell. Now, the reason I mentioned earlier an index fund, and just to stay with it, because that's a retirement fund, and just hold it. Don't worry about it. But there will be times too, if you get used to this business where, as I do, I actively invest. And so I'm out to beat the market, so to speak. So I was fortunate last year. That index I was talking about, VFIAX, was up 18.25%. A great year to be in that fund. Now, the portfolio that I actively manage is my own, was up 25.3%. And I was able to get that return without having to take a lot more risk than what the market was offering. If I had to take more risk to do it, it wouldn't have been worth it. But since I was able to rein in the risk while still getting the higher return, I ended the year, on a big smiling note. That was okay. And so far this year for the market, I'm up about what they would say is 1 percentage point above it, but I'm taking more risk. So far, I can't say it's been a real good bargain. The bargain hasn't been as good as it was last year, but we're only into February of this year, so we have a long way to go before year end. But these are the same things I share with students. In fact, I did something really unusual. This will sound crazy. I'm not afraid to say this. I had to teach this portfolio course last fall, okay? It was a quick course, meets 9 nights, okay? And I had to somehow keep the students engaged. So I broke the 25 students out into groups of 3 plus 1. And I said, each group, give me your best pitch. So here's what happened. I listened to these 8 different pitches. And so I invested in 4 stocks that they were recommending. And I said, whatever profits we make over a certain period by year end, I'll share with you. And the profits are all yours. If they're all losses, they're all mine. Well, folks, right now, I owe 25 students $300 each. Other comments, questions, suggestions, criticisms, complaints, concerns, or querulous inquiries? I know that sounds really unusual, but still, I said, this is what I'll do. So it certainly helped, if you will, draw the students in. It certainly helped in this case, if you will, promote, some good cohesion in the class. And so people were following these stocks over the short period. They sometimes send me a note, hey, when are we taking profits, blah, 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 blah. But in the end, it was a very interesting experiment, a costly experiment on the one hand, but one that certainly people will remember perhaps for the rest of their lives right here at Seton Hall. And maybe too, over the long run, they'll remember that. And then, of course, as we know from the so-called gifting, maybe they'll be able to join in the Stillman alumni and give back some money, okay? Remembering portfolio analysis.
Professor Levisek, what
Please call me Tony, it's fine, go ahead.
Tony, what students are asking, what is the course name and number that you're talking about?
This is an MBA course. It's called Portfolio Analysis, BFIN 7230.
Okay.
Yeah, let me get back here where I belong probably too.
Yeah, no problem.
Is there any hands up? Yeah, no, it's fine. And believe it or not too, in this particular course, sometimes people have come from off the streets. They said, hey, we heard about this course. Is it okay if we sit in? I said, of course. In fact, the way I got a job on Wall Street was many years ago. I was teaching here at Seton Hall, and there was an aspiring portfolio manager that just came to my office and said, I understand you're teaching a course in portfolio analysis. Can I sign up for it? I said, are you a student here? He says, no, I'm not. I said, then you'd have to, it's a mess. I said, there's already 50 students in the class. Why don't you just come by and sit in? What the heck? The university has got its money, right? And so later on, after he finished all the lecture, he says, would you like to join our firm? I said, no. And then one thing led to another. Some years later, he said, there's another opportunity. Would you like to join? I said, yes, we'll join. And just to let you know, too, how life in some cases works, the agreement we have is just based on a handshake. because so much in the world, as all of us know, is based on a 5-letter word called trust. And it's all on a handshake. And I can tell you, financial markets will pay a very high price for trust, because when money's on the line and you're making the trade, you better make sure that it goes through. And if something doesn't go through right, people get pretty upset in a hurry. And so all you need in some cases too is for a company, let's say, to say, hey, we've messed up our earnings and we have to restate our earnings, or we've got some internal problems and some people are resigning. Watch the stock price drop right away. Why? Because trust is broken. Trust is broken. So it's all boiling down to trust. And that's why, too, when I've helped people, I say, this is all based on trust. And so if I were to bring a new client on, I would tell the client, you are free to leave whenever you want. There's no binding contract here where you have to stay with the firm. Do what you think is best, but know that I will be with you all the way. Comments, questions, suggestions, criticisms, complaints, querulous inquiries once again?
Anything else?
I think I'm over my time. It's 36 minutes.
Yeah, you're great. You're great. Thank you so much, Tony.
Oh, sure. And anyone has any questions about investing, I can't promise, rates of return, they're going to hit the moon, but I might at least be able to tell you what you might be able to avoid, because that's part of it too. It's not just picking winners, but avoiding the losers. And I have to admit, as I've shown before, I've had some losers in my life, so I can tell you, no, that's not the place to go. Look over here instead. Fair enough?
Yes. Thank you so much.
Oh, thank you very much, Lisa. I really enjoyed this. I want to wish everyone, plenty of safety and good health. And once again, the future is for the bright and the bold and the courageous. See you later. Bye-bye.
Take care. Thanks, everybody, for coming.
Yes, thank you very much. Take care.
Thanks, Anthony. You're going to give us a recap on